So a warning at the start of this video: if you do not have a very good understanding of technical analysis and chart patterns, this video is probably going to go way over your head. It's going to be a Wyckoff volume spread analysis video specifically focused on breakouts from chart patterns and also understanding the supply and demand dynamics of what is going on in a pivot. MarketSmith are the sponsor of this video. There's a discounted trial available in the comments below if you are interested. So let me just give you an overview here of things that we're going to be covering. There's going to be some primary learning points, which are going to be these 6 different type of candlesticks and the interrelatedness with the volume as well. Now this is my own terminology, so I'll be teaching you it as we go in this video. There's going to be some secondary learning points as well. I really want you to be able to understand what are the tight areas on charts really mean from a supply and demand perspective, and how they can help you create more asymmetric risk versus reward trades, i.e. you're taking less risk and trying to maximize your reward as well. And we're going to be going in depth in terms of these 6 candlesticks. What do they mean and what do they infer from a supply and demand perspective, which can differ depending on the amount of volume. So let's just take an overview of the chart here. Appreciate it might look a little bit messy, but as we start working through here, breaking it down, hopefully it will make sense, but you may have to watch it a couple of times. Appreciate that. So what we've got here is a stock in the context of an uptrend. Now I'm showing you this on the 1 hour chart, but it's applicable across all time frames. It's supply and demand. It doesn't know time, it just knows supply and demand, buying and selling. The 1 hour chart here, as I've got it laid up, is just really nice for teaching some of the points that I want to be illustrating. So we've got a volatility contraction pattern that is then a low pivot breakout within that, which is very common when you're looking at these breakout patterns. A VCP, a volatility contraction pattern, in essence is a stock in the context of an uptrend building higher lows and then gets nice and tight in the pivot and breaks out. So what we can see here is we've got 3 contractions within the base. So we've got contraction 1 as we come down, little rally attempt, contraction 2, which is a higher low, little rally attempt, and then contraction 3, where price gets nice and tight and we have tight range bars, and we also have a trigger bar, and we have the volume drying up as well. So before we then start diving into it and then talking more so later on in this video from a trade management perspective, so I think there's 4 parts to trading. I think there is number 1, identify, which is this video is very much focused on that. Number 2 is controlling a risk, which we'll cover. Number 3 is mitigation of risk, we'll cover that. And then number 4, which I'll probably leave out of this video, is optimizing the profits. That is the 4 areas of every single trade to my mind. Let me just give you an overview of what on earth do these bars mean. So there are 6 generally candlesticks that I'm looking for as bases as pivots develop. So what on earth are they? Well, the end one, I'm going to start kind of at the end and work my way backwards. So the end one for me is a trigger bar. Now this is the final piece of the jigsaw puzzle. This is when you see a VCP, a Davis box, a flag, a cup and handle, something like that forming. The trigger bar, and this is whether it's on the weekly chart, the daily chart, or the 1 hour chart as we are here. The trigger bar is an indication that supply has stopped coming to market. This is a Jesse Livermore point. You can go and read about it in Reminiscences of a Stock Operator, or he wrote a couple books as well. But this is my interpretation of Livermore's point. The line of least resistance has formed, and in essence I'm looking for a little Davis box to form as well, whether it's the weekly chart, whether it's the daily chart, whether it's the 1 hour chart here, a little Davis box to form, and then this trigger bar come through, which is very similar to a tight range candlestick. The only difference is trigger bar is happening in the context of the final piece of the jigsaw puzzle of that optimal chart pattern: flag, VCP, cup and handle, Davis box, so on and so forth. So a trigger bar in essence is on a relative basis a tight candlestick that has low relative volume. So this black line that you see here, this is the 30 bar average. I keep it solid 30 bar average, whether I'm on the weekly, the daily, or the 1 hour. It does not matter. If you want to use the 20 bar, the 30 bar, the 40 bar, the 50 bar, you're in essence looking for a dry up in relative volume and a tight relative candlestick. Now why do I keep saying relative? Because everything is relative. You are comparing the stock's own action to the stock's prior action. You're not comparing this stock to how Apple is moving, to how Amazon is moving, to how Google is moving. No, you're comparing apples with apples, oranges with oranges. Compare the stock's action to the stock's own action. So I'm looking for tightness, relative tightness. And then as a side note as well, you can use the moving averages as reference point. Now this comes into the deliberate nature. There's a very good book called Peak by Anders Ericsson, all about building mental representations and deliberate practice. It's a very good audio book, but you can get the hardcover book as well. It's very good. It'll change how you actually go about learning new skills. Everything you want to do, you want to do it in a very deliberate manner. So you can use the moving averages, and I have 3 on the 1 hour chart. The black line is the 10 EMA, the blue line is the 21 EMA, and the purple line, or the pink line, lilac line, whatever you want to call it, is the 50 SMA. And you can see, and you'll see this time and time and time again, you can see the tightness coming, and then look how you have a clustering, a bunching of those key moving averages, and then you get the tightness and price coming through as well. Really nice reference points. Use the moving averages as a guideline, as a useful reference point for then where you're looking and expecting certain things to happen. You can also see, which we'll come on to, a couple of shakeout demand tails underneath the 50 SMA. See it in here, shakeout in here, then you have a shakeout underneath the 21 EMA, but specifically we're going to be looking at these shakeout demand tails in the base, and there's actually a third shakeout demand tail which just holds the 50 SMA. I'm even actually going to highlight that because we're going to talk about it a little bit later on, and also bring in the point of the volume and what is that telling you about supply and demand. So to conclude there, a trigger bar for me is the final piece of the jigsaw puzzle. It's a very tight candlestick, preferably sitting on one or more of those key moving averages, and has a dry up in relative volume. Let's just work back and let's go to tight range bars. As the name implies, tight range bars, and tight on a relative basis, preferably with dry ups in volume. Now we'll just talk a little bit here about what happens if you see a tight range bar in the context of a base building when you have a low relative volume and you have higher relative volume. So let's just point at these ones over here. So we have these ones over here, we have a tight range bar in here, we have a tight range bar here, we have a tight range bar or tight range bars prior to this trigger bar, and then we have a tight range bar over here, we have a tight range bar over here. Now to all the ones that I've just pointed at, and if we specifically look at this one here, okay, and I'm going to point to this and I'm going to make this arrow green, we're just going to talk about this tight range bar here. This, when you see this tight range bar and it is accompanied by low relative volume, that means there is very little supply that is coming to the market on that specific bar. Now again, context is very, very important. Are you seeing the stock in a downtrend? Are you seeing the stock in an uptrend? Has it recently broke out of a base and now testing the pivot and looking to reverse? Context, context, context. Very, very, very important. I cannot stress that enough. But when I see how this stock is broken out, it's pulled back, shakeout demand tail will come onto those, then a tight range bar, low relative volume, holding around these key moving averages just underneath the 10 there. That is an indication there's very little supply coming to the market. You can see it in here, you can see it in these tight range bars before the trigger bar, you can see it in the base, you can see it over here. So tight range bars, low relative volume, very little supply coming to the market. On the other side of that, if you have a tight range bar such as this one here, see how this is also a tight range bar. It's tight on a relative basis, and then look how the volume is actually around our 30 bar average. Tight range bar, high relative volume is an indication that supply is being absorbed. So tight range candlesticks, they can look the same, but the volume is telling you what is going on from a supply and demand perspective. Tight range bar, lower volume, less supply. Tight range bar, higher volume, more supply. So ideally in the pivot, in that kind of final action of an optimal chart pattern, VCP, flag, cup and handle, Davis box, whatever it is, you ideally want to see tight range bars and that trigger bar coming in, nice reference point at the moving averages as well. Now let's go on to shakeout demand tails. And we're going to be talking here about the volume as well, because shakeout demand tails can tell you either if there's a lot of supply coming to the market or not much supply coming to the market. How do we do that? Context, context, context here as well, right? So we're going to look at this base here because we've got one contraction with a shakeout demand tail, we've got two contractions in here, and we have another shakeout demand tail, and then we have our third and final contraction with another shakeout demand tail. Now, just first and foremost, what do you notice about the volume? These green bars here, so I'm just going to remove that green arrow now, sorry, these orange bars here, and I'm pointing to the volume bars associated with these candlesticks. What do you notice on the volume on each of these as we move from left to right? We're always moving from left to right, telling ourselves the story. What do you notice in terms of the volume? So this could be number 1, this could be number 2, this could be number 3. What do you notice? Is volume going up? Is volume going down? Volume's going down, isn't it? Okay, interesting. Think about what I was just blabbering on about with the tight range bars and what it means in terms of the level of volume. So you have shakeout demand tails, volume lessening. What is that telling you? it's telling you there's less supply coming to the market. You can also see that the depth of the shakeout demand tail is lessening each time as well. Interesting, isn't it? So we have one shakeout here underneath the 50, we rally. We have another shakeout here underneath the 50, volume lessens. Then we have another shakeout demand tail. The length of that demand tail is lessening and the volume is lessening. Interesting, right? Supply is lessening, and it's happening in the context of a VCP building higher lows, tightening. We have these tight range bars coming through, which are really nice to see soon after a shakeout demand tail. So such as this here, okay, if we just work through this a little bit, if we look at this final shakeout demand tail, the volume is around about half our 30 bar average. Then the next bar is actually a tight range bar, which actually indicates a little ease of movement as well. We'll talk about that. So shakeout demand tail on low volume, followed by either a bullish ease of movement or a tight range candlestick on low relative volume, is a very good indication there's very little supply coming to the market. Over here, where we have shakeout demand tail number 1, high relative volume, then we have a tight range bar where this green arrow is pointing to, and we have volume around the 30 bar average. This is more so a sign of absorption of supply. Interesting, isn't it? Let's go on to the next one. So I like to see shakeout demand tails in developing pivots, and I also like to see gap down reversal bars, especially if they happen in the first 1 hour of the session. Why the first 1 hour of the session? When do you think large operators in the market are most active? They are most active in the first hour of the session and also the last hour of the session. In between that, they're out for luncheons, they're having meetings and stuff like that. Obviously, I'm making a bit of a joke there, but I'm not. Large operators, just remember this, first hour, last hour is when they're most active. So you don't want to say that there's two most important candlesticks in the session, but the first hour and the last hour are where my eye is immediately drawn to, because that's where I know large operators are going to be active, especially that kind of early on candlestick in the session. So if you see gap down reversal bars in the first 1 hour of the session, I look at that as a very positive sign. If it's in the context of a developing base, again, context here. Where are you seeing the candlestick? Where are you seeing it in terms of the stock's trend? Where are you seeing it in terms of a base? Is it then happening later on in the base? Is it happening soon after a breakout? Is it happening on a test of a pivot after a recent breakout? Context is really important. Context and common sense, albeit common sense is not very common. So there's a couple of gap down reversal bars which I pointed to being blue here. Even better if it gaps down underneath a key moving averages and then recovers it, or gaps down onto it and recovers it as well. Again, context, because a lot of traders will use those moving averages as stop losses. So oftentimes you can see a gap down reversal bar, it'll open. So pre-market it's down, it gaps down on the open. Traders panic, weak hands panic as well. They sell out their shares on the open only to see it reverse high. It's a classic, as is a shakeout demand tail. A gap down reversal bar is also a shakeout tactic by large operators. So something to remember there. So there's a couple here. So on a gap down reversal bar, and you might be going, what on earth is a gap down reversal bar? Let me explain. So this bar here, and these vertical dash lines signal a trading session. So the prior close is here, okay? Prior close is here. Price then gaps down, opens here, and then closes here. Nice, and again, on a relative basis, this is quite a wide real body that we're seeing. It gaps down, reverses. Now, do you want another subtlety? We'll bring back the interrelatedness of price and the volume bar. What do you notice about the volume bar? Half the 30 bar average. What's that telling you about supply? There isn't much supply around. So as much as you're looking for these 6 different candlesticks, you're also then paying close attention to the volume as well. And then what is that inferring from a supply and demand perspective? Everything is linked back to supply and demand. It's all very, very logical when you think it through. This bar here is actually indicating to us there's this gap down reversal bar here. Why? Price closes here, sorry, and then it opens here and closes here. And volume pops up a bit more here. Okay, see the difference in volume from here to here. Which one has more supply? The result is pretty much the same. It's a little bit bigger on the second one, granted, but see how it takes more volume to propel the share price higher. This is then another Wyckoff concept of effort versus result. So this bar here is actually indicating that there's more supply around. Then what do you notice on the very next bar? Reversal bar coming through, and then closes pretty weak, but then there's no consistency of supply. Why? Because you have tight range bars, and then look at the volume. There just isn't any volume. There just isn't any selling pressure coming through. And then you have this nice shakeout demand tail, and then we spoke about the volume there as well, lessening volume. Nice to see. So this is a testing action. Another theme of the Wyckoff methodology is the principle and the psychology of testing as well. So shakeout demand tails on low volume, building higher lows is good testing action to see. Now let's talk about bullish synchronicity. So bullish synchronicity are, as I pointed to here with these yellow labels, which I call a BUS when I'm labeling them, so bus if you like. But bullish synchronicity candlesticks are widespread candlesticks where volume is confirming the positive price action. Now I also like to see bullish ease of movement bars. Now these two are very same in terms of the characteristics of the candlestick. The only difference for me between a bullish synchronicity candlestick and a bullish ease of movement candlestick is the volume. Bullish synchronicity candlesticks invariably occur on 30 bar average volume or above, and bullish ease of movement bars can do it on below 30 bar average, which is indicating an ease of movement to the upside. Why? Price is easily moving to the upside with little volume. So think about volume as effort. So it's taking little effort to propel the share price higher. Interesting, isn't it? But on a breakout, this is ideal. You would like to see a bullish synchronicity candlestick on large relative volume and or a bullish ease of movement bar. I don't mind which one, as long as it's getting out, the stock is getting out well after a breakout. So bullish synchronicity bars and bullish ease of movement bars are things that I'm looking for. Now before a base actually begins, and I'm going to see if I can draw a channel here, and let's make this channel green. So there's a rally prior to this base actually building, isn't there? See how this is then see how this is rallying. So something to be training your eye for as well is if you're trading a VCP, a low pivot within a VCP, Darvis box, flag, cup and handle, whatever it may be, ideally in the prior rally to the base, you would like to see combinations of bullish synchronicity bars, bullish ease of movement bars coming through as an indication that large operators are on your side, demand is on your side. There is interest in the stock. There is evidence that large operators are in here. Then as the base starts forming, you're looking for evidence that supply is being absorbed, signs of accumulation, which are candlesticks that I've just explained, gap down reversal bars, shakeout demand tails, nice tight bars coming through, trigger bars coming through, the stock respecting its key moving averages, holding those, building structural high lows, tightening nicely. And you're also looking for evidence that there are large operators distributing. And what are you going to see there? Well, you're going to see the opposite of, say, bullish synchronicity and bullish ease of movement. You're going to see bearish synchronicity. You're going to see bearish ease of movement to the downside. So sure, we see a couple of those bars early on in the base, but volume is so-so relative to what it is we've seen previously with these green bars. And then actually the largest volume bar after those is this nice big shakeout demand tail. So sure, no doubt there's some selling coming through here, but then take a look at this shakeout demand tail absorbing, shaking out the weak hands. Because remember, this bar here, you've got to have a lot of imagination in trading as well. You've got to be actually fairly creative. I'm dyslexic. You can probably tell by some of my kind of speech patterns as well. But I actually think if you are dyslexic, it can really help I'm left-handed as well. I don't know if that is any. I'm left-footed as well. But I play golf and snooker. I play right-handed, but I play tennis left-handed as a side point coming through there. I don't know whether there's other dyslexic people, and I've spoke to them. Some are actually accountants and things like that as well, where it can actually help people be more creative. Because I think when you're trading here, you're seeing a lot of people see problems, whereas I think if you're more so dyslexic and more creative orientated as well, you actually see solutions that many people may not actually be able to see. And that's why I think a lot of people kind of have a hard time understanding what is going on here. So maybe there is something there in terms of the viewing the market. But you also have to imagine that this bar here, it finishes with a nice shakeout demand tail, and you may have heard me blabber on about a Bayesian way of thinking. What on earth does that mean? A Bayesian way of thinking is basically just meaning as new information becomes available, you update your decision-making process. Because this bar here, if you just look at this candlestick, this shakeout demand tail in isolation, at one moment in time, it didn't look like that. It actually looked like this. And it was on the lows down here. It was on the lows. It looked terrible. If I draw a red box around this, I don't know how good this is going to look. Here you go. So if I do this, and I'll tell you what, let me see if I can make that like that. This candlestick, at one point in time, do you see that? It looked like this. this looks absolutely terrible. I've got no... Imagine if you were holding this stock and you were looking at this during the session, you'd be like, this is breaking down. Look at this. It's breaking down here. It's sliced through all the key moving averages. Volume is picking up. I'm out of this stock. I'm long gone. What did it do by the close? Shook you out, didn't it? It's a shakeout demand tail. Why do you think I call it a shakeout demand tail? I've been caught in 1,001 of these myself. Okay, this is why I've labelled them like this. I've been caught in not 1,000,001, but 1,001 shakeout demand tails easily. So it's understanding. It's designed to shake you out. Gap down reversal bars. Okay, they do not look like this by the close. So having this kind of Bayesian way of thinking, which again I think people really struggle mentally with this as well, is have the ability to quickly change your mind. Do not be dogmatic. Do not be rigid in your kind of analysis of supply and demand. Supply and demand it's fluid. It's always changing. It's like you've probably seen the Bruce Lee interview. Be like water, my friend. Your mind, you want to be like water when you're analyzing this. It's always changing. It's fluid. It's moving. You don't want to be rigid and go, oh, this is supply. Suddenly there's a shakeout demand tail, big shakeout demand tail. Suddenly it starts building high lows. Suddenly there's another shakeout demand tail, but volume's lessening. Then there's another high low. Then there's a collection of really tight candlesticks coming through. Then there's another really low volume shakeout demand tail. Then it's tight trigger bar coming in, and it's setting up perfectly. You have to change your mind really quickly when you're trading. I can be looking at a stock and think this is the best thing ever, and then the next session or an hour later I go, I have no interest in it, none. And my ego is not attached to that. I'll sometimes do it in these YouTube videos. There can be an area of the market that I think this is setting up right now. It's looking really interesting. It's setting up, individual stocks are setting up, but then there's potentially a bearish candlestick. I have no interest in it. My ego is not attached to it. I'm not going to try and fight. I'm not going to try and fight the market. It is what it is. But I think having kind of a context and a framework that you're then looking at this and thinking, yeah, okay, this is happening, that is happening, this is moving, that's moving, this is now doing that. I could potentially be targeting a trade here. So let's now go onto the trade management side of things a little bit. Sorry about that. That was my desk, not my desk, in my chair banging into my desk. So looking at this here, okay, why do you want to try and identify these tighter range areas on the chart? Why? What is the actual point of it? Well, there's a couple of points. Number one, the tighter range areas on the chart are indicating to you, especially if volume is drying up and it's built a VCP, a flat, cup and handle, Davis box, whatever. If it's setting up like this, it's an indication that there is less supply coming to the market. If you're targeting breakouts and ideally you'd like the share price to move up, so you're trading on the long side, you would like there to be very little supply coming to the market, correct? Probably. Why? Because if you think about supply and demand as effort, as volume, as scales as well, you would like very little weight on the supply side of the scale, because if there's an increase of weight on the demand side of the scale, what are your scales going to do? Your scales are going to do that. If your scales do that in favor of demand outweighing supply, what do you think price is going to do? Price is going to do that. It's going to go up. Nice, right? So this is why we want to look for those tighter areas on the chart. And then the question becomes is, well, if I said, okay, you have the opportunity to make $5, right? How much do you want to risk to try and make $5? If I said to you, okay, you could make $5 here, but you have to risk $4 to try and make your $5, is that as good a bet as if I said you could make $5, but you only got to risk $1, and your odds are you have a 35%, 40% chance of winning the $5? So same percentage of winning, or chance of winning. Let's just say it's 35-40% chance of winning. Scenario A, you have 35-40% chance of winning and you can win the $5, but you have to risk $4. Or scenario B, same 35-40% chance of winning that $5, but this time you only have to risk $1. Which bet do you want to take in isolation? And then which bet do you want to take 100 times, 1,000 times, 10,000 times? It's probably going to be the latter one. You want to risk less. So the expectation here is, okay, we understand what is going on from a supply and demand perspective. We have an expectation of what we expect to happen next, i.e. price breaks out to the upside like this. But our expectation is both thinking about things from a positive standpoint, price breaks out for us, but it's also thinking about things from a negative standpoint. What if we're wrong? How much do I want to risk to find out whether I'm wrong? Well, in that scenario of scenario A and scenario B, I don't want to risk the $4, I just want to risk the $1. Make sense? So here, my expectation is, okay, we've identified really tight area on the chart here, setting up nicely, key moving averages, There's nice tight range bars coming through. There's a trigger bar coming through. Volume's dried up. Okay, great. So with my stop, I can just place my stop here. Make sense? I'm not having to place my stop all the way down here, or maybe even worse, you're not placing a stop loss. That's even worse. That's a cardinal sin right there. But here, my expectation is, and I'm okay with either outcome. It's about thinking of things in terms of a series of trades. In any given trade, anything can happen in isolation. What you're trying to do is think about things in a series of trades. Okay, if I take this trade 100 times, 1,000 times, 10,000 times, what do I expect to happen over that large series of trades? What do I expect to happen? Well, my expectation is, number one, price should break out very quickly through this pivot point, and I should be at multiples of my risk quickly, where I can then free roll the trade. However, I am also expecting, if I'm wrong, and I can go, so I'm expecting whether I'm right, I'm expecting this to happen, and I'm expecting, if I'm wrong, I want to get stopped out of this very quickly, because I want two things to happen. Number one is I want to lose a small relative amount in terms of where am I targeting and achieving my average gain, and number two, I want to lose very, very quickly, because I don't want to have my capital tied up for a month, 6 months, a year, 10 years. You've all been there. You've all held that loss for a year, 5 years, 10 years. You've all been there. I've been there myself. You have to look at it every day in your portfolio. We've all been there. We've all done it. So with this here, I'm going into it thinking, okay, I'm targeting it here. Positive intention. I'm expecting it to break out. I'm thinking about then the mitigation side of things, which I'm not going to go super in depth in this video. I'm trying to free roll it. You can see other videos on the channel for that. I'm then going into the optimizing profit. So if I think it gets extended from one or more key moving averages, I may choke it off, lower the bar, lower the bar, lower the bar. But ideally, I'm trying to ride one or more of these key moving averages and capture the intermediate term trend, and I'm an intermediate term trend follower. So that is my expectation there. But I'm also thinking I may be wrong on this trade, and actually I'm more likely to be wrong on this trade. So I have to have a plan there, that I'm okay with either outcome to happen. And then I think there's a really interesting video. Actually, I know this video is getting really long. I'm a big fan of Johnny Wilkinson. Many of you would have heard him, especially if you're from the UK. You'll know all about Johnny Wilkinson, especially if you watch rugby as well. I don't usually talk about other channels, but there's a really good channel called the High Performance Podcast, and I would highly recommend you to watch the interview with Johnny Wilkinson. I think it's really, really good. And what he talks about is the psychology behind things as well, and actually kind of letting go of whatever is going to happen next, instead of kind of being really dependent on what is going to happen next. Change your mentality. And this is something that I actually struggle with myself, and I'm trying to get better at it. I'm trying to improve myself every single day as well, is instead of being really focused on the outcome here, be curious about the outcome. If you think about, I have a 20-month-old daughter, and when Ella's doing something, she's not focused on the outcome. She's curious. If you ever watch a child playing, a toddler playing, or a baby playing, whatever it may be, or a small child, they're not outcome focused. They're curious about the outcome, and that's kind of the innocence of it as well, right? So actually, with trades like this, and I can find myself mentally going down a rabbit hole, and I do it, and I go, I really, really, really want this to work. I want it to work, and you're so focused on the outcome, and it's then almost sod's law. You get knocked out of the position, where you've probably had some trades as well, where you've just seen a setup, and you flow in. It just looks good, and you just go, yeah, nice trade, I'll put it on. And you're then not worrying about what is it going to do. And it's usually the ones where you just not in a lackadaisical kind of mentality, but you're just like, yeah, it's a nice setup, I'm feeling it, right, I'll put it on. And then you almost forget about it. I've actually experienced those trades are usually my best trades. The ones where I almost put it on and forget about it, instead of like obsess on the outcome and like scrutinize it and have that you've been there, right? You have that feeling of this needs to work. Where actually, if you put it on, I'm curious, what is going to happen? I don't know what's going to happen. And that then kind of leads into that Bayesian mentality of, I don't know what's going to happen, but I'm going to adapt to what is happening. Okay, has the stock now got out to a given percentage where I can free roll the trade? So I mitigate the risk and take all of the risk out of the trade. Okay, great. Okay, now we're undergoing some testing action, but I'm seeing shakeout demand tail, volume is lessening, tight range bar, no volume. That's just telling me there's hardly any supply coming through. Next session, bullish synchronicity coming through, tight. Look at this shakeout demand tail. See how it just keeps happening time and time again. Nothing changes, just nothing. As a famous book says, there's nothing new under the sun, right? Shakeout demand tail. What do you notice about the volume? There ain't any volume. What does that tell you about supply? There ain't any supply. Then you have a tight range bar. Look at the volume. There ain't any volume. What does that tell you about supply? There ain't any supply. What do you see in the next bar? Bullish synchronicity. Interesting, isn't it? So it's kind of having that. It's something that I'm working on a lot with my own trading, actually, because you can get into these mental ruts of being so kind of obsessed on the outcome and wanting things to happen. You can then go into, I'm sure some of you are a little bit kind of spiritual as well, but if you want something and you desire something, you're telling the universe that you don't actually have that thing. It's an interesting kind of paradox, if you like, as well. So wanting something so much can actually push it away from you. Something I'm working on in my own trading is being very much focused more so on the systems and the processes involved, and coming away from being focused on the actual outcome and just being curious, letting the trade unfold however the trade is going to unfold. Because once you've bought it, you can sit here, you can stare at your monitor, you can scream and shout all you like. The stock doesn't care, the market doesn't care, unless you are going to put buy orders in, okay, and be part of the demand pushing up. You cannot influence the stock at all. The stock is going to do whatever the stock is going to do. So having an acceptance around that and just kind of stepping back and go, I'm curious, how is this trade going to play out? Is it going to be one of my big winners of the year? Is it just going to be an average gainer of the year? Is it going to be one where I get stopped out in half an hour? Is it going to be one where I free roll the trade and then I get stopped out a day later? I don't know, but I'm curious. I'm gonna find out. So I've probably made this video way too long. I've probably gone into some rabbit holes down there in terms of what is going on from a supply and demand perspective, what is going on from an own psychology standpoint with myself as well. Just being honest with you guys, some things that I'm doing in my own trading as well. But either way, I hope that video helps you. You may have to watch it a couple of times, as there's some fairly advanced kind of topics in there from a supply and demand perspective. But hopefully you guys enjoyed that video. I'll film a couple more like these in coming weeks as well, so look out for those on the channel. And as always, thank you very much for watching, and I'll see you in a future video.